Good morning and welcome to this Wednesday, February 19th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is a big day here at EarningsBeats because it is time to select the new portfolios. We do it the 19th every 3 months. So it's February, May, August, and November. And the reason for the timing is we want to get all the earnings reports in, or the majority of the earnings reports in, and then take a look at how the charts are reacting to those earnings reports and put together the best stocks that we can find to round out portfolios as we go forward. We've had some really good results to date, inception to date, in each of our 4 portfolios. Well, the last portfolio wasn't so good last quarter, but we'll be talking more about that later today in our webinar. But that webinar starts at 5 o'clock today. So for those of you that are members at EarningsBeats, just keep in mind that we will start that webinar at 5 o'clock this evening, and we will be sending out room instructions. There will be something later today, probably in the daily market report, but if not, we will definitely be sending out instructions. So be on the lookout for that this afternoon. If you are not a member of EarningsBeats, that's a great time to join. We do have a special running where if you sign up and pay the $7 for a 30-day trial, we'll refund you the $7. So there's really no cost over 30 days. And that trial subscription does get you into these events. So this evening or this afternoon's event, the top 10 stocks for each of the portfolios, or as I've been calling it, really the EarningsBeats draft, where we are able to draft the stocks that we want for our portfolios. That all starts this afternoon at 5 o'clock. I am at the home page right here. You can see if you go to the home page, if you're not familiar with EarningsBeats, just go to EarningsBeats.com. And here at the top, you'll see webinar, top 10 stocks. And if you click here on the little link, then you'll see the performance that we've had and just a brief description of what we do. But here you can see the model portfolio started November 19th, 2018. Remember that fourth quarter of 2018. November 19th was right before we had that big drop in December. So it didn't start at the best time. And yet here we are, February of 2020, just 15 months later, and that portfolio is up 58%. And the S&P 500 has done very well, up 25%, but you can see the outperformance has been pretty solid. May 19th, aggressive portfolio and income portfolios both have beaten since that date. You can see their cumulative return since inception. The S&P 500, 17.86% since May 19th, and you can see both of these aggressive and income portfolios have outperformed pretty nicely in just 9 months. And then finally, as I mentioned, not such a great time for the character change or the CC portfolio. This was a new portfolio, November 19th, that we set up really just to try to capture companies that were just beginning to start to move higher. So these other 3 portfolios have put together stocks that not only beat Wall Street estimates as to both revenues and earnings, but they also looked really good on their charts. They'd been in nice uptrends. A lot of them were just getting continuation gap after continuation gap, had been long-term leaders relative to the S&P 500. And so that's kind of the makeup of those 3 portfolios. The CC portfolio was a little bit different. We wanted to give it a shot and see how it worked out. And I certainly believe it's still way too early to pass judgment. And there were a couple of reasons for the poor performance. But essentially what this group was designed to do was to take advantage of stocks that had been downtrending and then came out with a good report and gapped up. So it's like a character change in their chart from downtrending to uptrending. Now, a couple of the reasons, well, we had there, I would have expected maybe 7 of the stocks to perform really well and then maybe 3 not to perform well. It's been more of like 5 and 5, which I think is going to turn out to be an anomaly. We'll find out as we go forward. So that was one thing that hurt the portfolio. There was just as many down stocks since November 19th as there were up stocks. So a lot of those stocks that had been downtrending and then gapped up simply rolled over and started downtrending again. Whereas half of them I mean, I can tell you one of the stocks that's done very well, Square. Stock went in, I don't know, probably around $60 or something. Now it's over 80. So there have been some real good winners, but they've been offset by some that continued their prior downtrends. The other thing that factors into both the character change portfolio and the aggressive portfolio is that both of these portfolios are made up of all small and mid cap stocks. That's not to say that's always going to be that way, but I think in this last quarter they were all small and mid caps. There may have been one large cap in the aggressive. I have to go back and look. But the majority is small and mid cap. And if you've been following small and mid cap stocks, you know that they've been underperforming the S&P 500. So taking the performance of the aggressive and the character change portfolio and comparing it to the S&P 500, to be honest, isn't really fair. The fact that the aggressive portfolio has outperformed the S&P when it's been invested primarily in small and mid cap stocks is pretty impressive. But anyway, we'll see what happens in the quarters ahead as far as the character change portfolio goes. And I'm going to mix some things up a little bit tonight with that. So there'll be a few surprises. I think we're going to improve on that performance going forward. And we'll talk about that a little bit later today. But anyway, if you're not a member of EarningsBeats and you would like to become one and join me tonight for that, for the top 10 stocks, please join us. I mean, again, you're going to get charged the $7 for the 30-day trial, but we will refund it. You'll get that refund. It shows within 5 to 10 days, probably isn't going to be that long. But you'll get your refund, and you can enjoy the service for 30 days for free. See if it's something that can help you in your trading. We do a lot more than just these portfolios, by the way. I have a daily market report that goes out every day. I'm not signed in right now, but there's a daily market report. I think you can go ahead and here, there's a sample of the daily market report. You can go ahead and check out and see, the types of things, but you can see it's a very, very lengthy report, lots of charts, gives you a lot of trading ideas. Here you can see Roku was pointed out when it hit a support level down near 100. And this stock it held that level. It's been very volatile, but it held that level. But you can see there's just a lot of information that comes out every day in the daily market report. I will tell you though, if you're a member, today's daily market report is going to be very, very slim pickings. It'll probably be a very brief report today because I am preparing for tonight's webinar. So just be on the lookout. It'll probably be a very quick one paragraph type of thing today. But this is the type of report you would get on a daily basis. It goes out every day between about noon and 1 o'clock Eastern. There are some exceptions, but generally it goes out around that time. I would say the average probably is around noon. Okay, let's move on here. Let's take a look at what happened yesterday in the market, because we did see the market move mostly lower. You can see the NASDAQ eked out a 1.5 point gain, but all the other indices were down. The Dow Jones was down 165 points, or a little more than 0.5%. The S&P was down just a little under 10 points. Mid-cap stocks down another 7 points, 1/3 of 1% roughly, and small caps down more than 1/2 of 1%. And back down at 1,012. I would really like to see the small caps make this breakout above 1,025. Might be tough to do it here in the near term. Those of you who know me know I follow the market pretty closely on a historical basis. And today, the 19th, does mark the beginning of the worst 1 week period within all calendar months. So, I've broken down the historical S&P 500 performance since 1950 by day of the month, and the 19th to the 25th, if you combine all calendar months. It doesn't apply to all of them. December is an exception. November's a little bit of an exception. But for the most part, the 19th to the 25th of calendar months tends to be the weakest part of the month. And I say tends because it doesn't happen every month. So if we're sitting here on the 25th and the market's gone up another 1%, please don't come back and say, well, you said it was going to go down. I'm not saying it's going to go down. I'm saying that historically, the tendency is for the market to relax or even to pull back this time of the month. And the primary reason for that is options expire the third Friday of every month. So that's this Friday. So in 2 more days, which is the 21st, options expire. So as you get close to option expiration day on that third Friday and the week following, I think there's some, I don't want to call it manipulation, but it's manipulation. in the market due to the options expiring. A lot of folks selling, or getting out of their current options and then going forward and reestablishing new options. And there's just a lot of stuff going on around options expiration week. And I have a feeling that that is the primary culprit for why we see it so weak. All right, looking at the sectors, you can see utilities leading to the upside, but we did have some leadership from a couple of aggressive areas. So even though the market was down yesterday, a couple of the aggressive areas did okay. You could see communication services gaining 0.2%. Discretionary stocks were flat, which is not bad when you've got the Dow down 165 points. Utilities, though, were the leader, and you can see utilities have been strong. Talked about this a little bit yesterday. The environment that we're in is a little different than what we're used to. We're not used to being in a very, very low interest rate environment with strengthening economic conditions. Normally, when the economy is strengthening, you would see interest rates rising. Folks would be moving out of treasuries and into equities. But low inflation is keeping the Fed on the sidelines, and I think will even encourage them to lower rates later this year, although we did get a pretty hot PPI number out this morning. I'll talk about it in just a second. But anyway, the low interest rate environment sets up well for utilities and real estate. You can see real estate also been doing very well lately. So I don't know that this is going to be one of those situations where all the money rotates away from defensive stocks and into aggressive stocks. I think that there's still a market for utilities and real estate when you've got exceptionally low treasury yields, because those two sectors have companies that pay really healthy dividends. So those looking for income will stick with utilities and real estate. And so there's still that, part, that dynamic, or that part of what's going on that we have to be aware of. I don't believe utilities and real estate are going to lead the bull market. I believe they'll take a back seat, but I don't know that they're going to be as weak as we might normally expect them to be. And then finally, financials were the worst performer yesterday. We did go down, test both the 20 and the 50-day moving average before coming back up and closing above. Financials have been struggling with the 10-year treasury yield remaining very low. Speaking of that 10-year treasury yield, let's get a quick update. Had some economic reports out this morning. January housing starts, 1,567,000 units. The market only expecting 1,420,000 units. Huge beat. And I saw a headline that said, housing starts fall. And I mean, this is a little bit of what I have a problem with the media. To me, that should not have been the headline. Yes, it did fall from December to January. Housing starts, I think in December, were 1.6 million units, something like that. Now it's 1.567. But the market was anticipating a huge drop, and we didn't get it. So instead of saying that housing starts beats by 10% estimates, I saw the headline, housing starts fall. Again, it's all the way you spin things. Housing starts were strong. Building permits also strong, 1,551,000 versus 1,453,000. So about 100,000 top there. December numbers were both revised slightly higher as well. So not only did we get a much stronger than expected January number, but also the December numbers were revised slightly higher. On the flip side, though, so all of that would have suggested to me that, hey, the economy's great, and as long as we've got no inflation, things are, nirvana for stocks. Well, we got a little fly in the ointment this morning. January PPI, all of a sudden, out of the blue, up 0.5%, up 0.5%. Market was only expecting 0.1% of 1%. When I saw that headline number, I'm like, well, let's strip out, food and energy and see what the core number is. Core number is the same thing, up 0.5% versus 0.1%. I'm not exactly sure. I mean, it's only one number. I'm not going to overreact to one number, but that was a pretty big number that came in. And yet, when I look at the 10-year treasury yield today, you would think, this is what the Fed wants. The Fed wants to inflate the economy. And I think that's the only thing that's been lacking. And one of the reasons why the treasury yields have not really been moving up. Money continues to pour into treasuries. And I think a lot of the bond traders believe that the Fed will cut again. There's about, I think I saw 70%. I think there's about a 70% chance that, based on the way the bond market's trading, there's about a 70% chance that the Fed will cut by September, and about a 49% chance that they'll cut twice by the end of the year. And yet, we're hearing from Fed officials that say they're going to stand pat. But trust me, we've heard this before. I mean, if nothing else, if you go back and look at the history of this Fed at the end of 2018 and throughout 2019, not only were they wrong, but they were on the wrong side of the tracks. When the bond market was saying cut rates, they were raising rates and threatening to raise more. And now we know where they are. They came around and listened to the bond market. I think the bond market's a pretty smart market. It's actually, in my opinion, smarter than the stock market. And so I like to pay attention to what's going on in the bond market. I think the bond market still is saying that there's a cut coming. Look at the 10-year treasury yield. It's at 1.55. It's up 1.5 basis points after a huge economic report in terms of housing numbers, and much higher than expected inflation. All of that should result in folks wanting to sell out of treasuries. And yet here we are with the yield up just 1.5 basis points. Looking at that data, I would have expected when I pulled up the 10-year treasury yield, it would have been 1.65, maybe up 10, 11, 12 basis points. So the bond market, I think, continues to send this message. And I'm going to listen to the bond market rather than looking at these, one report on the PPI. That's just my take. Now, when I look at this chart, this is a 2-month hourly chart on the 10-year treasury yield. And I wanted to just point out the downtrend. Here was a high, here was a low, here's a lower high. Here we would come down. It looked like maybe we were going to put in a higher low. So it almost looked like a little bit of what kind of a triangle am I trying to say here? A symmetrical. There we go. I couldn't come up with the word. I want to call it a cyclical. Symmetrical triangle. And normally these symmetrical triangles, when they break in the direction of the prior trend, which was down. Now, maybe it was too early to call this a symmetrical triangle, but if you do see that pattern, we got the breakdown to the downside. So I would be careful, looking at this 10-year treasury yield, thinking that it's going to go up. I've been wanting to, for the last year, I've been saying, hey, 10-year treasury yield is going to go up. I'm not so sure until the Fed does what it needs to do to make sure that inflation doesn't get out of control to the downside. Again, this morning's report looks good, but let's see what happens from here. All right, next up, I wanted to go into, I want to break down the home construction group. And I just wrote an article here 45 minutes ago over at Stock Charts and talked a little bit about the home construction group. And when you look at the chart, you can see, move up, sideways consolidation, move up, sideways consolidation. And now we've broken out again on this daily chart. If you go to a weekly chart, not only are we moving higher, and this has been a common theme, something I've talked about for a long time. When the home construction group broke down below the 20-week moving average back in February of 2018, I said, you've got to be careful with home builders until we can get that push back up above the 20-week. When you move below the 20-week moving average, that's generally not a great thing. When you're above it, that's awesome. You're trending higher. When you're below it, and especially when the 20 crosses below the 50, I mean, these are all warning signs. This was a time you really didn't want to be in home construction. But when we opened 2019, we moved back above this 20-week moving average, and that is holding like a charm and continues to push higher. It's hard to say bearish things about home construction when you see this on the chart. I mean, fundamentally, everything lines up for the group as well. You've got strong jobs, so you got people with income. You've got low interest rates, historically low interest rates. I mean, these are all things that would suggest that this would be a strong group anyway, and technicals certainly support this. So this is a group that I would want to be focused on. So how can you go from here to finding some individual stocks? Well, first you can do the ETFs. I try to buy my own stocks because in an ETF, the problem is in an ETF, you've got some good stocks in there, but you've got some bad stocks. So the bad and the good kind of go together. I want to try to outperform. So I want to look for the best. So when I do that, I would do one of two things. Number one thing I would do is, because I have a strong earnings chart list at EarningsBeats, and by the way, if you are a member at EarningsBeats and you're also an extra member or above at Stock Charts, I'll send you a link. You literally click the link, type in the password I give you, and you can download this strong earnings chart list into your account. Look at all these charts. Right now, there's 320 of them, 320 charts on this chart list that have all beaten top and bottom line estimates. And I've annotated all of these charts as well, showing you the support levels that I would be looking for. But anyway, once you have this chart list, if you're not familiar with this feature, you can view all. And when you view all, you can go in here and hit the summary. And then I can take all of these, and then you can see they're sorted in scooter order. So you can see some of the top stocks: AMD, Tesla, NVDA, Dexcom, Documentum, I think is the name, Norton, Ring Industries or whatever, MSCI. I mean, these are Shopify, Lam Research. These are all the major stocks that are leading. So once you know that they've beaten, and if they're on this list, they've beaten top and bottom line their last quarter. That's the homework we do. We do all that homework for you. But you've already got the list of companies that have beaten. Now you can do whatever you want to do with this list. You can run scans against it. You can look at the top scooters. You can search it. Watch this, home construction. And I can find all the stocks on this list that have beaten earnings estimates and revenue estimates. And they're scooter ranked for me. So I can quickly find which ones I'm interested in. So the top one, without even looking, I got to believe Pulte is going to look pretty good on their chart. And sure enough, here's the uptrend, sideways consolidation. Actually, well, not quite an ascending triangle. We didn't quite get up here. But it was sideways consolidation for 2.5 months, 3 months, then breakout. Volume trends are strong. Now we're in this sideways consolidation mode again, but I suspect that we're probably going to set up for another breakout in Pulte. Next up, Lennar. I mean, I can go right down this list, but see how quickly, if I write in my daily market report, I really like home construction. It's making a breakout. You could take this chart list, literally go in and type in and see which companies have beaten on top and bottom line, and go to those individual charts and look to see where some of the key support levels are. You might be testing them. You may have already broken out. I mean, here we break out, we come back down, test the 20-day moving average, which a lot of times is a great entry. And look at that bullish engulfing candle right on the 20-day. And then we go up, we break out again to the upside. And with these numbers, I'm assuming home builders will probably do well again today. Although maybe the inflation numbers will scare some folks. I don't know. It'll be interesting to see how the home builders react today. But that's how you can take a group, go into the strong earnings chart list, and find some of the stocks. Now, another way to do it is if you're a non-member at EarningsBeats and you don't have the strong earnings chart list, then go over to the scooter reports. Large cap, they're in scooter order. Type in home construction. And there you go. Pulte, Lennar, DHI, NVR. I want to go and check out the mid caps. Oh, then you got Toll Brothers there. How about small cap home builders? Hovnanian and CCS, that was on my strong earnings chart list. That's another way that you can break down and quickly move into individual stocks. All right, let's move on to earnings. Earnings out last night. Verisk Analytics beat 113 versus 112 on the bottom line. Stock looks pretty good. I mean, the relative strength was in the doldrums till about a month and a half ago, started perking up. Nice volume trends this year as well. The stock was down just fractionally, down about 1/3 of 1% when I looked, but they did beat on their bottom line. So overall, not a bad looking stock. A couple of reports that came out with big reactions. I want to pull up first Amedisys, AMED. This was a company that's been on a roll, really strong relative performer. They beat 94 cents versus 93, but the stock is down 8.5% in pre-market. Now, a lot of times, and I've said this before, it's not always about guessing right and having a company that beats. When you get a company that's gone up as much as this company has, I mean, since the beginning of November, we've moved from under 130 to over 200. That's more than a 50% move. A lot of times you have the buy on rumor, sell on news. And I think that's what we're getting here with AMED. I wouldn't be surprised to see a big drop with a hollow candle. In other words, with the stock being bought after it gaps down. Next up, EMPH. My gosh, what a report. Bottom line, 39 cents versus 33. The stock is up 14% pre-market. It's over $45 a share. And when you look, it's been one of the leaders. So again, this one was telling us good things about the company, and we saw those good things coming out in the earnings report. Earlier this morning, some numbers. One of our portfolio stocks getting a boost, last minute boost before they get removed, or will they get removed? That's another question. Really strong report. Garmin beat on their bottom line $1.29 versus $1. Stock is up 9% in pre-market. So it is going to break out again on the open today. Good timing as it is coming out and getting us that pop right before we have to make some decisions at the close today. Let's see, ATHM, another one that's having a very strong reaction. $1.38 versus $1.24 on their bottom line. You can see the stock here has been downtrending mostly, and on a relative basis has not been a great performer, even though it's group trying to make a breakout. So will this be a change in character for ATHM? Stock is looking to open 6% higher, which would be roughly about $5. That takes us somewhere around 84. I'm not sure that's going to be enough to get things going here. I'd have to see a lot more than just that. And then the last one, ADI, analog devices. You can see just been going sideways, but it's in the red hot semiconductor group. They did come out, they beat $1.03 versus $1 on the bottom line. Stock is up about 5 2/3%, but it has not been one of the leaders. So we might get that breakout. I'll tell you what I would watch for on this stock would be whether it opens above 123.43. If it does, I find that to be very bullish. If it opens below 123.43 and trades above it, then be careful if it comes back down below. That could be a false breakout. But otherwise, I mean, we did get a good report, getting a nice reaction. So I'll try to be optimistic there. Let's see if we open above that 123.43 level. Okay, upgrades, downgrades. Going to go through these pretty quickly. First one is NVIDIA. The only upgrade, really, that's all that was notable. NVIDIA, one of the best stocks. Look at the stock breaking out relative to the semis. And of course, semis have been tracking higher versus the S&P 500. Volume trends are great. What's not to like here? NVIDIA looks great. In fact, one of the hardest things for me in putting together these portfolios is which semiconductor stocks to include, because there are a ton to pick from, including NVIDIA. Downgrades, we had Dunkin'. So Dunkin' Brands was downgraded today. When you look at the relative strength here, it's down to a 52-week relative low to the restaurants, and restaurants not doing much better versus the S&P 500. So I would have to agree with the downgrade. Stock's down 1% in pre-market. Not a fan here. One other, actually, let me give you these other two real quick. LDOS downgraded. Have no idea why. Stock breaking out. It's in the strengthening computer services group, and it's one of the best stocks in the group. And I looked, and the stock was up 2.4% in pre-market. So somebody's downgrading it. The market says we don't care. I completely disagree with that downgrade. And then finally, network appliance, NTAP. This one's being downgraded, and this one I agree with. You've got the computer hardware group making almost a parabolic move to the upside, and yet NTAP can't make any headway whatsoever. And it looks like it's rolling back over again. Fell with its earnings just a few days ago. I think it's going to break down. I look for it maybe to go back down toward this 44, 45 area. Just, these are the type of stocks I want no part of. Stocks that are down trending relative to their peers and the S&P, even though their peers are very strong relative to the S&P. No thank you for NTAP. All right, let's wrap it up with the three you must see. I'm going to start off. I'm going to give you some smaller stocks here, a couple of small stocks. I don't talk about the smaller ones too often, but let's go with Rockwell Medical Technologies. It's in medical supplies. I think we're probably, well, shouldn't say we're going to get it, but it looks to me like we could maybe make about a 4 or 5 month breakout relative to the medical supplies group, which has already broken out. The volume trends all of a sudden getting very strong, and we closed yesterday at the highest level in the last 4 or 5 months. So RMTI, I think, looks pretty interesting. MoneyGram, MGI, another smaller stock, $3 stock here, had been downtrending. Look at the volume come in yesterday, though, as it breaks above this high. So now we've got the double bottom in play, and we're clearing that point right there. I would expect that this stock's going to run and fill this gap to 350. If it can get through 350, then you got another gap up closer to 4. But just that reversal with the double bottom and the breakout of this intermediate high here, with the increasing volume being in a very strong group, that's also really important. This is a group that's being favored by Wall Street. So you got a small company, maybe a pullback to 280. If it were to pull back short term to the breakout level, that might be a little bit better entry than the chase after a 15% move. But I do think this one looks pretty good. And then I'm going to wrap up with something most of you probably fall off your chair here, but looking at Wheaton Precious Metals. I don't talk about any precious metals very often because the dollar's been strong for 8 or 9 years. So it's really difficult to see some of the precious metals do well. But it's hard to ignore this chart. Moving up, sideways consolidating. Look at the volume yesterday, take off on that breakout above $31. This one looks pretty strong as well. So for those of you who do like to trade these stocks, I want to also, look for stocks in these other areas that maybe that don't interest me, but may interest you. That's it for today. Again, we got a big event coming up tonight. Would love to have you join us. If you're not already an EarningsBeats member, go in, sign up for a $7 30-day trial. Within a few days, we'll refund you that $7. So there's really no cost to check out the service for 30 days. But we'd love to have you. Big night today for later today for EarningsBeats. All right, everybody, have a great day. Enjoy your afternoon later, and hopefully see you this afternoon. Take care. Happy trading.